You decide to buy a TV. So you go to your nearby Chroma to check it out. Of course, you're attracted to the TV that is 2 inches wider and 20,000 rupees costlier than the one you zeroed down to online. So there you are, debating between two screens, Einsteinian calculations running in your head, when a shop assistant magically appears by your side and tells you how that bigger TV will add joy to your life, how the screen has so many pixels that you can literally see the pores of the people on the screen. And just when you say that it's too expensive, he says, don't worry, we have zero cost EMI, only 5,000 rupees per month. And you're like, great, 5,000 rupees is nothing. You press the trigger. 2 months later, the next iPhone comes out. Suddenly your perfectly fine phone feels too inadequate. You walk in the store, some other salesperson comes behind you, whispers sweet nothings in your ear, and you're out of there with another 3,000 rupees per month loan. And of course, a brand new phone. And this goes on for a while. The whole world around you seems to be dying to give you yet another zero cost EMI, yet another new credit card, yet another no documentation required personal loan. And before you know it, you can no longer afford supporting all of these loans. And so now you take on more loans not to fund discretionary one-off purchases, but to support your regular lifestyle. And you start to default on some of these loans. Your credit card company or your finance company sends recovery agents to your house and office to harass you. And while you and many other Indians are struggling to repay these loans, remember all these finance companies have also borrowed from banks to fund that loan to you. And guess what? Banks are sitting on your deposits. And Bhagavan is watching all of this from above and shaking his head. What Bhagavan? Well, for anything to do with loans and deposits, the main Bhagavan is the RBI. The RBI's job is to ensure that the system doesn't crash. And God knows that sometimes you defaulting on your loan could end up being the first domino that ends up toppling all these other dominoes in the financial system. And so it's the RBI's job to act preemptively to nip the problem in the bud. So a few days back, it did exactly this. Now, like most RBI announcements, the actual notification on their website is an extremely dry, technical piece of text that makes no sense to a layman. But get through the jargon and there's actually a very interesting story going on. So what did the RBI announce? Well, that risk weights on consumer loans, credit card loans, bank loans to non-bank financial companies, NBFCs, are to be increased by 25 percentage points. But what on earth does this mean? So first things first, major lenders in our systems are banks, so your SBIs, ICICIs, Kotaks, and then there are non-bank financial companies or NBFCs like Bajaj Finance, L&T Finance, Shriram Finance, etc. These are part of a set of entities known as shadow banks. What's the difference? Well, if you keep the technicalities aside, banks are in the business of taking deposits and giving out loans, and also offering banking services. On the other hand, shadow banks cannot take on deposits, at least most of them can't. They instead borrow either from the market or from banks and then use that money to lend to consumers and firms. And the reason both exist is that often shadow banks are more nimble and can reach customers who need loans which banks may struggle to reach. Now, the RBI's main headache is that if too many customers start to default on their loans, does the bank or the shadow bank have enough capital to save themselves from collapsing? So the RBI has regulations in place that if you want to lend X amount of money, you better have Y amount of capital. An easy way to think about capital is to say the shareholding of banks. So essentially it's reserves, the building block that you need to build a bank or a shadow bank. Now, how does the RBI ensure that the entity has enough capital? Well, again, there's a lot of complexity involved, but essentially what the RBI tries to do is to fix a percent of capital, which is a percent of how much the bank has lent out. So let's say that the percentage which is mandated is 8%. Whatever you've lent out, you should have capital in your reserves worth at least 8% of it. So let's say you've given out loans worth 10,000 rupees and your capital is 1,000 rupees. Then your capital ratio is 1,000 divided by 10,000, so 10%, which is higher than the RBI's, let's say, mandatory level of 8%, which means you are adequately capitalized. But here's the problem. What if one bank has given 10,000 rupees of home loans, while another bank has given 10,000 rupees of credit card loans? Now, home loans are more stable than credit card loans. If a customer defaults, the bank can always sell the underlying house. So intuitively, if you were in the RBI, wouldn't you want the credit card giving bank to allocate more capital than the home loan bank? So the RBI resolves this through the concept of risk-weighted loans while calculating the percent, or risk-weighted assets, because loans are essentially assets of banks. So the RBI can say, look, I need credit card loans to have a risk weight of say 125%, while housing loans say get an 80% weight. What does this mean? Well, if you are a bank that mostly does home loans, you may have given out 10,000 rupees worth of loans, but the RBI says relax. For calculating your capital ratio, you can consider it to be 8,000 or 80% weight. So if you have a capital of 1,000 rupees, then your capital ratio now becomes not 10%, but 1,000 divided by 8,000, 12.5%. So the RBI says, feel free to give more loans. You have more than enough capital. My minimum requirement is only 8%. Your capital ratio is at 12.5%. On the flip side, banks that give out credit card loans attracts say 125% risk weight. So for the 10,000 rupees that they lent out, RBI's calculation considers it at 12,500 rupees. That is 25% higher. So what happens to the capital ratio? Well, for the same 1,000 rupees of capital, the ratio is 1,000 divided by 12,500, not 10,000. So 8%. So then the RBI says, halt, you can't give any more loans because you've already hit the lower bound of 8%. If you want to give more loans, you better raise your share capital beyond 1,000 rupees. So this is a really powerful tool for the RBI. It can control who is lending what to which sector simply by tweaking these risk weights. Now last week, the RBI raised the risk weight on consumer loans by 25%. So 100% becomes 125%. It also raised it for banks lending to non-bank financial companies. Remember, banks lend not only to you and me, but also to corporates and also to non-bank finance corporations. So RBI is like, even if banks may not be giving unsecured loans too much, it is ultimately supporting entities that are giving these risky loans. But why has the RBI gone about penalizing banks and NBFCs on consumer loans? That's because unsecured consumer loans are picking up sharply in India. So we've actually done an entire episode of The Bond Economist on the cracks in India's consumption story. I'll leave a link at the end. The point is that much of India's credit growth currently is happening in the retail sector. And within it, unsecured loans seem to be a hot favorite. More and more people are taking on 3, 4, 5 loans at one time. Now, it could be because people may be becoming more aspirational, but it could also be that people's incomes, particularly those at the bottom of the pyramid, have struggled to keep up, and high inflation has hit them badly. Economists are calling this the K-shaped recovery. So the upper strata of the K is doing great, while the lower strata is struggling. Again, do watch my previous video on India's consumption story for more on this, and of course, please do subscribe. So it is a bit concerning that people are taking on more and more loans. What is probably even more concerning is that more and more people are defaulting on these loans, to the point that the RBI seems to have concluded that this can put the financial system at risk, and so we need to apply brakes on this. So now that they've applied these brakes, how will it exactly play out in the economy? Well, two ways really. First, as we explained earlier in the video, making the risk weights higher on the unsecured loans means that banks realize that for every 100 rupees that they lend out in that sector, their capital ratio gets more negatively impacted compared to lending the same 100 rupees, say for a home loan. Now, a bank can still say, look, I make more money on a credit card loan or lending to a non-bank financial corporation than a home loan. And the RBI will then say, fine, but then I'm forcing you to increase your capital to cover for any potential losses. Now for NBFCs, there's a double hit. Not only does it have to raise more capital, but because the RBI is also penalizing the banks for lending to them, their cost of credit is going to go up. which means that the interest rates that they charge on these unsecured loans may also increase. And the RBI's hope is that it either gets too hard to get or too expensive for you, the consumer, to take on yet another zero-cost EMI loan. I mean, by the way, the RBI has another tool also to control the flow of credit in the economy. It's a powerful tool, and it's called the policy interest rate, which is the interest rate to which all interest rates in the country are linked to. Now, this has been raised from 4% last year to 6.5% this year to basically make credit more expensive, slow down the economy, and in the process bring down inflation. So technically, the RBI could raise interest rates even higher than 6.5% if it wanted to stop you from spending more on your credit card. But A, it's a blunt tool, because not only will credit card loans see higher interest rates, but so will loans that corporate take to run their businesses, home loans, auto loans, basically all loans in the system. And B, that might not be a great thing to do because inflation has come off quite a lot from last year. And there's a lesser need to slow down the economy to control that inflation. On the other hand, tweaking of risk weights is a smart way to target only that bit in the economy where you think there's a problem. What's the expression? Kill the snake, but save the stick. For more such insights, like, share, and subscribe to The Bond Economist.